We want to talk deal making and AI. Joining us right now to do just that is Blair Effron. He is the co-founder of Centerview Partners. And Blair, thank you for coming in today.
Thank you. Thanks for having me.
It feels like there is activity kind of percolating in a lot of different industries. What are you seeing right now?
It remains busy. It's busy all year. You know, if you think about last year, we ended at $4.5 trillion, which was the second highest ever, despite a little bit of a slowdown given the situation.
Because of the Iran war.
Iran, pricing of oil, obviously. It remains busy, and we'll probably end the year strongly, $4 trillion, and across most sectors.
You know, it actually surprises me that higher oil prices and what's happening in Iran would slow things down much when you are continuing to watch the indexes hit new highs every day.
So it is more the band of uncertainty has expanded, but also the band of resilience has grown. So, again, we're seeing activity. Last week there was a big real estate deal, the biggest retail ever. I think you will, with 3 IPOs, when the IPO market's active, it always helps M&A. So I think we'll percolate through the year nicely.
What do you hear in terms of the IPO market? It also seems like a lot of people are kind of in a rush to hit while the markets are hot.
Becky, people are always in a rush when the markets are hot. Nothing unusual here. The bigger thing to me will be how much comfort these 3 deals get. And if they are getting the tailwind that we're all thinking about, it'll have an overall great effect for the markets generally. And the bigger question is going to be the economy longer term. We just think about 27. That's going to be really for the M&A business, the biggest determinant.
Are there issues where, you know, the CapEx, we were talking earlier this morning, the Conference Board has its latest issue that says CapEx spending, even though consumers or CEOs are worried about what's happening in the economy, they are continuing to make sure that they are spending on CapEx. It's almost required because of AI.
What strikes me on that is only 5% of CEOs recently polled said that they will lower CapEx from projections. The rest will raise. More importantly, you have $700 billion, which we all talk about, of CapEx coming from the big 4 hyperscalers. To put that in perspective, in 2021, we did a $1.2 trillion bipartisan infrastructure bill over 10 years, and we thought that was a huge tailwind. So the point is the tailwind here is substantial. The bigger question is going to be when and how much is the return on this investment. Like any time you see this, I'm betting investors will demand a return sooner than one might think.
We had one guest who told us earlier today that all that CapEx spending, when they worry about the economy and protecting their margins, means that they're buying less of their own shares in buybacks. I also wonder, you don't see that. Okay, that's what I wondered. Does it take away from other initiatives, from either hiring, from M&A activity, from buybacks?
So let's parse that out. The first quarter, you saw robust earnings. 2/3 of the S&P 500 surpassed estimates. I think you'll see that in the second quarter as well. Cash flow numbers as strong as ever. And the best companies are having the flexibility to invest in CapEx, give money back to shareholders, and think about M&A. And I think that's actually what's going on. So what is more to the point is by the time you get to the third quarter, I actually do think you'll start to see a little bit of a slowdown in this outsized earnings growth relative to estimates. Inflation will start working its way through. The margin question, last quarter, every company, basically, the average margin was up substantially. You wouldn't have expected that. It'll be the same this quarter. I think that's going to start to level out. And that will be interesting to me to see if the market can stay at 22 times PE once that happens.
AI question on a personal basis. We actually talked to Greg Fleming about this yesterday.
Greg is, I'm sure, very good with AI.
Well, no, but I assume that your firm is now using AI.
Aggressively.
Aggressively, okay. So are you finding that whatever you're spending on AI today is justified? Meaning that when you look at the productivity gains of the employees that are on your staff, you're saying, wow, they're able to do 2x, 3x, 5x, whatever they were doing before, and therefore we're able to make 5x what we made before? Or are you saying that they're now able to go home earlier? What's the big distinction?
Andrew, that's the question of the day. I think for us, AI has been unalloyed positive. We look at it as a revenue-enhancing tool, not a productivity tool.
Okay.
If I can free up 20, 30% of our colleagues to focus on more strategic, more client-oriented, more higher-margin business, that's a good thing, number one. Number two, the level of analysis, when done right, frankly, blows me away. Now, you're talking to somebody who still likes an abacus, but when I see my younger colleagues show me analysis, and I said, this must have taken me 3 weeks. No, a couple hours.
Right.
And it's great analysis. So if you look at a firm like ours, you look at law firms, you look at banking firms generally, I think we'll be using it differently than how companies are using it. I will tell you that the rate of uptake, the rate of adoption among companies, I think is slower than people think if you are not tech native.
Does it mean you're freeing up these workers to do other bigger thought processes that bring in more revenue? Does it mean you're slowing your hiring?
I do think there is this question of hire and freeze. I do think the numbers are slowing down, but let's put it in perspective. Over the past 2 months, the most recent data says there are 100,000 jobs lost to AI, yet the past 2 months, employment, 140,000 on average. So what you really need is an economy to keep growing. Every 1% of GDP is 1 million jobs. That's the key. Now, is there a dislocation? Becky, we're all concerned about that, and I think there needs to be a deep national agenda and conversation about what we're going to do to reskill and take care of people during this period of dislocation.
Hey, Blair, I imagine a certain percentage of your job is hand-holding for your clients to try to make...
Certain percentage?
Yeah. What percentage of your job is hand-holding?
I would say hand-holding.
Well, making them feel better as...
I think a big part of my job is to be a sounding board to really talented CEOs who, for the most part, know what they want to do, or they have a choice A versus B, and you're debating and batting around the idea. So it's not necessarily hand-holding. It is a voice for the executive to bounce things off of.
What are the issues that are getting bounced off of you right now? What are the top issues?
I think the top issue is how much money to put into AI and still get the return, to Andrew's question. Second issue is this question of this is the time of year you start making business plans for next year. Do I look at GDP growth? Last year, this time, CEOs were saying for the most 2.5% growth. It's been dialed back to 1.5%. I'm starting to hear a lot about 2027 as a big issue, and I do see a level of caution coming into the 27 projections.